Welcome to this deep dive, where we take a complicated stack of earnings documents and, well, distill what you actually need to know.
Yep.
Today, we're dissecting the Q4 2025 earnings call for United Community Banks. That's UCB. And this one really is a deep dive into execution.
It absolutely is. I mean, the regional banking environment is still, let's say, a minefield. It's so sensitive to margin pressure, to credit quality.
Right.
So our mission today is to cut through all that noise and really understand why management felt so confident calling this an execution quarter.
And more importantly, why the market, after some initial confusion, completely agreed with them.
Exactly. That strange open is a huge part of the story.
So we'll start with that snapshot. The headline numbers were, they were solid. Operating earnings per share came in at 71 cents.
Right on the money, perfectly in line with what Wall Street was expecting.
But the top line, the revenue, that's where we saw the first little hint of a surprise. It came in at $278.4 million.
Which was a beat. Not a massive one, but a meaningful one. About $4.84 million ahead of forecasts.
Okay, so inline earnings, a revenue beat. You'd think that's pretty straightforward.
You would think. But that's where the story gets really interesting. In the pre-market, the stock just got hammered.
Yeah.
It was facing some pretty sharp selling pressure.
So it looked like a total disappointment.
A total miss. But then, the regular session opened, people had a moment to actually read the transcript, and the stock just took off.
It ended the day up nearly 2.8%.
And on huge volume, too, about 39% higher than average. It tells you the knee-jerk reaction was completely wrong.
And that, for you as an investor or just a learner, is fascinating. It means that once the details were actually digested, the market decided the quality of those earnings was what mattered.
It was a powerful validation. The initial fear was just about, general regional bank weakness, but the execution details from UCB just blew that pessimism out of the water.
So the whole report, the whole call really came down to two key things.
Two repeatable levers: margin expansion and just relentless cost control.
All right, let's unpack that. Let's start with the net interest margin, the NM. I mean, that's the lifeblood of any bank.
And we saw real proof of execution here. Their FTE NIM expanded to 3.37%.
Okay, 3.37%. Put that in context for us.
Well, management made a point to highlight that's an 18 basis point expansion year over year. To get that kind of lift in this environment, it just suggests they have exceptional discipline.
Because so many of their peers are getting squeezed on that.
They are struggling. They're battling deposit outflows, surging cost of funds. UCB is separating from the pack.
So drilling down, what's actually driving it? It can't just be luck.
No, it's what they call balance sheet choreography. It's mechanical.
Yeah.
The main catalyst was a lower cost of funds. It improved 21 basis points just in the quarter, landing at 1.76%.
So how are they pulling that off?
It's all about setting up the balance sheet for these structural tailwinds. So on the asset side, they have $1.4 billion of assets, loans, securities that are maturing in 2026.
And repricing at what rate?
At a rate of 4.90%. So as those older, lower rate assets roll off, they get recycled into the current market. That's a huge structural benefit.
And what about the other side of the balance sheet? The liabilities.
Just as optimized. They have another $1.4 billion, this time in high-cost CDs, maturing in just the first quarter of 2026. Those are rolling off at a rate of 3.32%.
But are they keeping those deposits? Because that's the key.
But that is the absolute key. And they're retaining them at a lower average rate, around 3.13%. Their CD retention rate is clocking in at around 90%.
90%. It's incredible.
It's far beyond what you're seeing in the industry. It proves they have sticky relationships. It gives them pricing power.
Okay, so for anyone listening, you have to be wondering about sustainability. They're guiding for NIM to be up another 2 to 4 basis points in Q1. Is that realistic?
It is, because it's based on that maturity schedule we just talked about. They're less reliant on what the Fed does tomorrow and more focused on the replacement rates of their existing book. They're just harvesting those built-in tailwinds.
Okay, so the revenue side seems solid. Let's pivot to the second leg of that stool, expenses. Because Q4 operating expenses did jump up. They hit $151.4 million.
Right, and that could have been the source of that initial pre-market panic.
So what's the story there?
Context. It's all about context. The increase was tied to two very specific things. First, a $1.5 million catch-up in group health insurance.
A one-off adjustment.
A non-recurring adjustment. And second, higher incentive pay. Why? Because they had record loan production.
So it's not bloat. It's basically a success tax.
It's a success tax. That's a great way to put it. And when you look forward, management is targeting a really tight 3.0 to 3.5% growth rate for expenses in 2026.
Which in banking, if you can hold your costs in that range, you're just generating massive operating leverage.
Significant leverage. And they backed it up too. They expect Q1 expenses to be flat with Q4, even while absorbing things like the FICA tax restart in January.
That is a serious commitment, holding the line.
It absolutely is. And it underpins their whole story. Revenue grows faster than expenses, which flows right to the bottom line for you, the shareholder.
So they've proven the model. Grow revenue smartly, control costs tightly. Where does that lead? How are they deploying all this capital they're generating?
Well, capital strength is clearly a priority. Their CET1 ratio is very robust at 13.4%. They have plenty of dry powder.
But what's really critical is what they're doing with it.
Exactly. And they were aggressive on capital return. They bought back 1 million shares in Q4 alone at an average price just under $30.
And they didn't just stop there. They signaled a huge pivot for the bank going forward.
A monumental pivot. They explicitly said they intend to be, and this is a quote, more assertive on buybacks in 2026.
And that is such a powerful signal to the market.
It tells you they believe their own stock is undervalued. And it tells you they think their internal growth opportunities are way better than going out and making some expensive acquisition.
Which connects directly to their growth. I mean, organic loan growth was solid, 4.4% annualized.
And in good categories too. C&I, ATLOCs, sticky stuff. Their production teams are hitting record numbers, like $1 billion in originations from their retail and equipment finance teams for the first time ever.
And that feeds right into the M&A outlook. Management was so clear on this.
Crystal clear. M&A is now a secondary focus. They said they love their footprint and are only interested in a, quote, very limited number of targets.
They even put a number on it, didn't they? Less than 10.
Less than 10 high-quality, non-fixer-upper targets. That's an incredibly high bar. It signals so much confidence.
So they aren't looking to buy scale or fix problems.
No, they're saying, we have the model, we have the scale, and any deal has to fit our culture and be immediately accretive. The focus is internal quality control, not external risk.
Which brings us to the biggest risk factor of all, credit quality. If you're talking durability, you have to have a clean credit profile. Are there any cracks starting to show?
Management was very confident here, and the headline numbers look good. Non-performing loans are low at just 0.39% of assets.
There's always a but.
The Q4 charge-off rate was higher than expected. It spiked to 34 basis points, and we need to understand why.
So that jump was driven by two very specific losses, right? They detailed them on the call. The first one was a $6 million charge-off on a franchise loan.
Right, a $14 million loan. And the key there is that the franchisee and the franchisor had a disagreement, and the stores ended up closing instead of being sold.
So it's an idiosyncratic, one-off business failure, not a sign of broad economic stress.
Exactly. And the second loss was just as unique, a $4 million charge-off on an SBA loan.
And this one was due to a documentation error.
A documentation error during underwriting. It meant the bank decided not to even pursue the government guarantee, which, it does raise a question about internal control.
It's the first time in 12 years they've had to do that.
It is. But if you step back, the fact that management can point to two very specific, very distinct anecdotes to explain the whole variance, it suggests there's no systemic weakness. It's two unique failures, not a worrying trend.
And that really matters for the forward outlook. They expect the overall loss rate for 2026 to be stable, right?
Right back in their normal range. 20 to 25 basis points. They're telling you they don't see Q4's spike repeating.
Did they mention anything about the macro, like tariffs?
They did a check on that, and they confirmed they're not seeing any negative impact flowing through to their borrowers. So the region they're in seems pretty resilient.
Okay, let's connect all these dots. We have margin expansion from the balance sheet, tight cost control, a pivot to aggressive buybacks, and stable credit. How does this stack up against the rest of the industry?
It stacks up remarkably well, and the market is rewarding them for it. If you look at UCB's stock over the past year, it was up 4.21%.
And the regional bank ETF, the KRE?
The KRE was up just 0.90% over that same period. UCB is generating some serious alpha. They're proving they're different.
So the market rewarded them for delivering exactly what the sector needs right now.
The precise combination: margin discipline, tight costs, and clean credit. That rally after the call was the market saying, we finally get it, we validate the execution.
So the next checkpoints are pretty clear. Can they keep expanding in IM? Can they hold that expense line?
And can they keep that credit loss rate in the 20 to 25 basis point range? They've set a very high bar for themselves.
And now, as is tradition, we transition to our This Is Not Financial Advice segment. These are just ideas to chew on, leveraging what we've learned from the call.
Absolutely just ideas. But given management's very strong pivot away from M&A and towards being more assertive on buybacks, the trade should be about monetizing UCB's internal quality.
Lay it out for us.
The proposition is a relative value trade. You go long UCB shares and you finance it by shorting the KRE regional bank ETF.
A classic quality versus the field kind of trade.
Exactly. It's a quality versus trash paired trade. You are betting that UCB's superior execution, the margin control, the cost discipline, and especially that aggressive buyback plan is going to drive alpha no matter what the rest of the sector does.
So you're betting on them being an island of stability in a pretty challenged sea.
It's a bet on their execution over the macro environment.
That makes a ton of sense. So to recap our deep dive, UCB delivered an inline 71 EPS, a solid revenue beat, and drove their NIM up to 3.37% through some really smart balance sheet management.
And they committed to that aggressive pivot. Share repurchases over M&A, all supported by a stable, if noisy, credit picture.
Right.
But there's one last point. Management spent a surprising amount of time talking about culture, about their awards for client and employee satisfaction.
That's interesting.
It is, and it raises a question for you, the listener, to think about. In a sector that is so quantitative, so capital intensive, how much does an investment in something intangible like culture actually contribute to the durable earnings that drove that market recovery?
Does a happy workforce literally translate into basis points of margin?
That's the question. Maybe the metrics are the evidence, but the machine producing them, the culture, is what really matters.
That's a fascinating thread to pull on. Thank you for joining us for this deep dive into United Community Banks. We hope this analysis helps you cut through all the noise.